Last week, mortgage rates finally dropped below 6% for the first time since 2022. The spring housing market was about to wake up. Buyers were coming back, sellers were listing. For the first time in years, it actually felt like things were moving in the right direction. And then bombs started falling in Iran, oil prices have spiked, and the Strait of Hormuz is barely functioning and in most cases closed. Mortgage rates jumped right back above 6% practically overnight, and now every headline is screaming that the housing market is in trouble again. But here's the thing that nobody is actually talking about. This war might actually be one of the best things to happen for home buyers in years. Now, I know that sounds insane, so let me explain. Okay, first, let's get the facts straight so you understand what just happened. The US and Israel launched military operations against Iran. In response, oil tanker traffic through the Strait of Hormuz dropped 90%. That waterway carries about 20% of the world's crude oil. Shipping costs from the US to Asia hit all-time records, and oil prices spiked above $82 a barrel. And because higher oil means higher inflation risk, bond markets panicked. The 10-year Treasury yield jumped, and mortgage rates, which follow the 10-year, went from 5.98% to 6% basically overnight. Now, here's where most people stop. They see that headline and they think, great, another setback. I'll just wait. But that reaction, that is exactly the opportunity. See, what most people don't realize is that when uncertainty spikes, the housing market doesn't just slow down. It completely thins out. Scared buyers pull back. They sit on the sidelines to wait. They tell themselves they'll wait until things settle down. And that's completely understandable. But here's what it actually means for the buyers who stay in the market. There's going to be less competition, fewer bidding wars, and more negotiating power. See, think about it. Before this war started, housing inventory was already at its highest level since 2020. Active listings were up 10% year over year. About a third of sellers were already cutting their prices. The market was finally shifting toward buyers after years of being stacked against them. Now you add a layer of geopolitical shock on top of that, sellers who need to move are suddenly facing a buyer pool that just got cut in half. That means more price cuts. That means more seller concessions. And that means closing cost help and inspection repairs that you would never have gotten 6 months ago. So if you're a buyer with stable income and you don't panic, you just walked into a clearance sale that nobody else showed up to. But wait, it actually gets even better. This is the part that really matters and almost nobody is talking about it. Yes, mortgage rates have ticked back up above 6%. That's real, but here's what you need to understand about how oil shocks actually work. There are two forces fighting each other right now. Force number one is inflation fear. Oil goes up, gas goes up, shipping costs go up, everything gets more expensive. That pushes rates higher in the short term, and that's what we're seeing right now. But force number two is economic slowdown. When energy costs spike, people spend less, businesses pull back, and the economy cools. And when the economy cools, investors rush into safe assets like treasury bonds. Bond prices go up, yields come down, and mortgage rates follow them down. This is not theory. This is what happens almost every single time. During the Gulf War in 1990, oil prices doubled from about $17 to over $36 a barrel. The initial reaction was panic, but then the Fed actually cut interest rates from 8% all the way down to 3% over the next 2 years as the economy slowed. That same pattern also played out after the 2011 Libya crisis, and again after the Russian-Ukraine shock in 2022. In fact, analysts have studied over 30 years of Middle East conflicts, and the pattern is remarkably consistent. Oil spikes hard, markets panic, and then within a few months, prices come back down as supply chains adjust and economic reality takes over. So what does that mean for you? It means the rate spike you're seeing today is very likely going to be temporary. And if you lock in a purchase now while competition is low and sellers are desperate, you could refinance into a lower rate in 6 to 12 months when the dust settles. The old saying is marry the house, date the rate. And right now, that's not just a cliche. It's a genuine strategy backed by how these situations have actually played out historically. Now you may be thinking, okay, but what if this time is different? So that's a fair question. So let's look at what the data actually says. JP Morgan's commodities team has been saying for months that the global oil market is fundamentally oversupplied. Even before this war, they were forecasting oil prices to average in the high 50s to $60 a barrel for 2026. Their view is that the geopolitical spikes tend to be temporary and the underlying market is soft. The U.S. Energy Information Administration agrees to that. They're projecting global oil production to exceed demand, with prices falling to around $58 a barrel on average this year. Even OPEC just met on March 1st and announced they're adding production back to the market. So the baseline is clear. The world has plenty of oil. What it doesn't have right now is a clear shipping route through the Strait of Hormuz. And the US has already announced it will escort oil tankers through the strait to keep supply flowing. Does that mean the prices snap back tomorrow? Of course not. There's going to be volatility. There will be scary headlines for weeks, maybe even months. But here's the key insight. Housing decisions are not day trading decisions. You're not buying a house for the next 3 weeks. You're buying it for the next 5, 10, or 30 years. And on that timeline, a temporary oil shock driven by a military conflict is noise, not signal. And while everyone else is frozen staring at the news, the actual market conditions for buying a home right now are the best they've been in years. But now I've got to be honest with you, because I don't want anyone watching this to do something reckless. This opportunity is real, but it's not for everyone. If your job is tied to energy prices or industries that get hammered by oil shocks, this is probably not the time to stretch your budget on a home. If you're already at the absolute maximum of what you can afford and one increase would break you, this is definitely not the time. If you need to sell a home before you can buy one, the uncertainty cuts both ways. Your sale may take longer or bring less than you expected. This is more of an opportunity for buyers who are financially stable, who have their own down payment ready, who have job security that doesn't depend on what happens in the Middle East, and who understand the short-term volatility. And that's the price that you pay for long-term value. If that's you, the math right now is genuinely in your favor. So look, here's the bottom line. Every few months, something big and scary happens in the world. A war breaks out, oil spikes, markets wobble. And every single time, the overwhelming majority of people react the same way. They freeze, they wait, they tell themselves they'll act when things calm down. But things never really calm down, especially in the housing market. There's always the next crisis. And the people who build wealth through real estate are not the people who wait for calm. They're the people who understand what's actually happening beneath the headlines. Right now, beneath the headlines, you've got the most housing inventory since 2020. You've got mortgage rates that are still a full percentage point lower than this time last year. You've got sellers cutting prices. And you've got a war that just scared half of your competition out of the market. That's not a crisis for home buyers. That's a window. And windows close. Let me know your thoughts on this. Do you agree? Comment down below, and I'll see you next time.